10 financial ratios to make smarter investment decisions. Understanding financial ratios is like having a GPS for your investments. Without them, you're just guessing. Today, we'll uncover 10 financial ratios that can help you make smarter investment decisions. Not only will we explain each ratio, but we'll also show you real-world examples so you can confidently use these in your analysis. Let's dive in. Number 10, debt-to-equity ratio. The debt-to-equity ratio compares how much money a company borrows, debt, to how much its owners have invested, equity. It shows how a company is financed. A lower ratio often indicates that the company uses less leverage, which reduces its financial risk. I prefer a debt-to-equity ratio below 80%. Examples of companies with a debt-to-equity ratio below 80% include Cintas Corporation, 66%, IDEXX Laboratories, 62%, Microsoft, 34%. Number 9, net debt-free cash flow. Wondering how long it would take for a company to pay off its debt entirely? The net debt-free cash flow ratio calculates this. A lower number means the company can handle its debts easily, making it less likely to run into financial trouble. I prefer a net debt-free cash flow ratio below 4x, meaning the company should be able to pay off its debt in less than 4 years using all its free cash flow. Examples include Qualys, 2.4x, net cash position, Zoetis, 2.2x, Visa, 0.4x. Number 8, CAPEX, cash from operations. This ratio gives an indication of the capital intensity of a company. It measures how much of the operational cash flow is used for capital expenditures, or CAPEX, which refers to the money a company spends to buy, maintain, or improve its long-term assets like buildings or machinery. The less capital a company needs for its regular business activities, the more money it has for other purposes, such as paying down debt or paying dividends. I prefer this metric to be lower than 25%. Examples of companies with a CAPEX cash from operations ratio below 25% include KKR & Co., 1.5%, Apple, 8.0%, S&P Global, 2.6%. Number 7, return on equity, ROE. ROE shows how well a company turns the money from its shareholders or equity into profits. A high ROE means the company is rewarding its shareholders efficiently. I look for companies with an ROE higher than 20%. Examples include Automatic Data Processing, 87.3%, Games Workshop, 62.1%, Hamilton Lane, 23.0%. Number 6, return on invested capital, ROIC. The ROIC gives an indication of how efficiently a company allocates its capital. For example, if a company has an ROIC of 15%, it generates $15 in profit for every $100 of invested capital. A high ROIC indicates efficient capital allocation. I prefer companies with an ROIC higher than 15%. Examples include Domino's Pizza, 54.6%, Lululemon Athletica, 37.5%, MSCI, 26.9%. Number 5, gross margin. The gross margin shows how much money is left after paying for the cost of making a product, such as materials and labor. A higher gross margin means the company keeps more money from each sale to cover other expenses and make a profit. Consistently high margins also indicate strong pricing power. I typically look for companies with a gross margin over 40%. Examples include Moody's, 72.9%, AutoZone, 53.1%, Alphabet, 58.1%. Number 4, free cash flow margin, FCF margin. The free cash flow margin is the percentage of a company's sales that turns into free cash flow, which is the money left after all expenses and investments. The higher the FCF margin, the higher the profitability. Look for companies with an FCF margin over 10%. Examples include Moody's, 72.9%, AutoZone, 53.1%, Alphabet, 58.1%. Number 3, dividend yield. The dividend yield is the percentage of a company's stock price that it pays out to shareholders as dividends each year. The higher the dividend yield, the more the company pays out to shareholders. This metric is especially useful for income-focused investors. Examples include Pfizer, 6.4%, Transdigm Group, 5.9%, the Kraft Heinz Company, 5.6%. Number 2, price to earnings, PE, ratio. The PE ratio compares a company's stock price to its earnings, or profits, per share. A lower PE might indicate that the stock is cheap, while a higher PE suggests that people expect the company to grow in the future. Look for companies where the current PE ratio is lower than the average PE ratio over the past 5 years. Examples include Dreamfinders Homes, 7.3x, 5-year historical average, 10.2x, SDI Group, 16.1x, 5-year historical average, 29.2x, Kainos Group, 18.0x, 5-year historical average, 41.6x. Number 1, free cash flow yield, FCF yield. Free cash flow yield measures how much free cash flow a company generates compared to its market capitalization. A high FCF yield indicates the company is trading at cheap valuation levels. Try to find companies where the current FCF yield is higher than the average FCF yield over the past 5 years. Examples include Kinsale Capital, 9.9%, 5-year historical average, 7.8%. Nike, 5.2%, 5-year historical average, 2.8%. Medpace, 4.9%, 5-year historical average, 4.7%.